My name is Hansley, and now this Sunday afternoon we are doing trading plan basics. And as you can see here, this trading plan is going to be the basics for your trader success, for your career, whether at the beginning, whether you're intermediate, whether you're advanced, whether just a quick refresher of what you need. These are the basics you need to stick to and adhere to in order to be a profitable trader. So we are going to cover three things. We are going to cover master. We're going to cover the trading plan, mindset of a trader, and actually placing trades. So with that being said, let's dive straight into it. And also, if you are on Zoom, can you please mute your mic to me, please? And we can do questions and answers afterwards. Thank you very much. So with that being said, let's dive straight in to our training for this afternoon. Mindset of a trader. Now, first one, don't get emotionally attached to the outcome. What do I mean by that is, as you get started, whether it's on a demo account or on a live account, when you lose a trade, what tends to happen is you tend to get emotionally attached and you start to think, oh my goodness, I just lost money, right? Or you could be the opposite spectrum and realize, yes, I just literally just made X amount. Now, whether it's winning or whether it's losing, whether you're over ecstatic or you're really hurt you lost, you have to detach yourself from that outcome. Because if you're excited and you've won X amount, what's going to happen is you may want to put on another trade. If you've just lost now, for example, you might lost a lot and you're like, oh my goodness, is this really for me? No. So you have to ensure that you control your emotions when it comes to trading, even before you start to trading, and have an understanding of that. Now, whatever you do a trade, be patient once you've done that trade. If a setup's not there yet, for example, don't rush it. Don't rush the process. Be patient. Trust your analysis. Stick to a handful of pairs. Now, when I mean stick to a handful of pairs, I don't mean have like 10, 11, 12. I mean literally have between 3 and 5 pairs. Why? Because you want to master those pairs, but we're going to get onto that very shortly afterwards. But when it comes to a handful of pairs, you need to ensure that you know those pairs in and out. Trust your analysis, and your analysis is all about the technical analysis. Now, I'm doing the markups. This is using your indicators. This is trusting what you've done for your markups. Be confident. Now, once you've placed the trade, for example, stick with it. Whatever it is, just stick with it. Sometimes it might go good, it might go bad, depending on what it is. Just be confident in what you've done. Be very decisive for what you're doing. When you place a trade, you have to be committed. You have to go all in. There's no in our end, because what's going to happen is price action is going to change. Put your ego aside. What do I mean that is? What I mean by put your ego aside is just that when you're making X amount, don't go in for more trades, because what's going to happen is you may end up losing, and that means you're going to be emotional. Like I said before, don't get emotionally attached to the outcome, and always react to the markets. Don't predict it. Now, this is always a part of your analysis, but this is like kind of the fundamentals of the mindset of a trader. Because even before you start looking at charts, all this kind of stuff, you need to have these things in check as a basic for me, and what I've learned with our resource, our platform we have, and whilst going to other traders. There's many more other things, but this is what I believe is the mindset of a trader whilst you're getting started. Now, trading plan. Remember, we haven't started trading yet. This is a trading plan to help you start to get to trade. Before trading, look at the news. That is the most important thing when it comes to trading, is looking at the news, because the news has a huge impact no matter what you're trading, whether it's currency, whether it's indices, whether it's commodities such as gold, oil and silver. And as we know currently at the moment, oil has been very volatile. I know many people that's actually won, and I know many people have actually blown their accounts. And when I mean blown their accounts, I mean losing £50,000, £20,000, £15,000. Many people have lost just because they are not looking on the news, or they're putting their trust in somebody else. And this is why you need to have a trading plan, and you need to be in control of your money. Now, limit the amount of trades per day that you do, especially if you're beginning. and you have a low account, whether it's £50, whether it's £500, whether it's $1,000, you need to limit the amount of trades you do per day. Now, me personally, if you're just beginning and you're just setting out, I would say stick to at least 3 to 5 trades per day. And with those trades, have a limit and actually how you administer those trades. So if your target is 3 trades for the day and you lost your first trade, I might suggest maybe don't trade again that day. Or if you did lose and it's not that much because you decided, okay, this is not a good trade, pull out. No, think more wisely and trust your analysis for the second one and even possibly the third one, depending on how it's going to go. You know, as a minimum, give yourself a target to compound weekly. Now, I was speaking with a good friend of mine, and he pretty much said, start with something like 10%. Now, no matter what your account size is, 10% is highly achievable. So let me just give you an example. If you have £100 in your account, your life account, and you want to make 10% of that week, all you need to make is £10 for that week, right? Which means that's literally £2 per day on a 0.0 lot size. That's highly achievable, especially if you're doing one of our trading plans for the 20 pips and dips. You can literally do 1 trade a day, get your 20 pips, and you're done for the day, right? That's what we can do for your compounding weekly. Now, for those of you who are more advanced, you can maybe set yourself a target of 10% per day to compound. But remember, this is just the basic, but we want to start small. And when we do small compounds, it makes life much more easier. And I don't know if any of you have read the book Compound Effect by Darren Hardy, but I'd highly recommend it. Why? Because he talks about the compounding penny. Now, he talks about if you had 1 penny, double that for 30 days, rather than having £10,000 for that month. What do people have? People would rather have the £10,000. But over the 30 days, on the 28th day and the 29th day, you're actually going to have 20,000 just from that compounding penny. Now, that's what I mean by small increments. It may seem small now, but over weeks, months, years, the more you better your skills, the more you can change how you compound. But for now, stick to weekly compound. I would suggest 10%. It depends where you are and how confident you are, especially on a life account. Be strict on your risk to reward. Now, even myself, I've done this many a times. I've actually risked, maybe 20. I might have risked, for example, I might have risked £2. I've risked £2 to make maybe £1.50 or £1.75 because I've seen the setup and I've seen that price action is not going to go down where I need it. What I should have done, I should have left it, but because I was eager, I wanted to trade, I wanted to get that money in, right? That's what I did. That's not a very good risk to reward. I'm losing more money. I'm risking more to make less. That doesn't make no sense, and I've done it. This is why it's important to be very strict. I wouldn't be like a one-on-one, risk £1 to make £1. So what I should have done is I should have waited for a better setup on price action, and I could have risked £2 to make £2. At least it's mainly even. So be very strict on that. And if you're going to risk, make sure you're risking more to gain more and not the opposite way around, because it is very easy to do, and I've done it, especially when you're new to trading and you start moving up. Now, don't risk no more than 5% of your account. Ideally, you want to risk 2 to 3% per trade. And the reason I said 5% as a maximum, because it actually depends on your account, right? Now, if you've only got like $50 in your account or $75 in your account, so to speak, risking 2 to 3% might not be high enough for the risk to reward that you want. Now, you could do, risk like £1.20 to make £1.20. You could do, but ideally, if you want to compound it, it's better to actually risk a bit more so you can gain a bit more. So depending on your account, I would always say no more than 5%, but ideally 2 to 3%. So if you had an account size of $100 I would say you could risk between 2 to 3%, because you will then be risking £3 per trade, which you can get a very nice 20 pips and dips, which is one of our strategies, right? Which is about £1.50, £1.66, £1.70, depending on your broker, on your lot size and their spread size. You can actually do that per trade, and I'd highly recommend it. Don't stop studying. Now, when it comes to trading, you have to study. Trading is not something, we have a very good 2-week syllabus, but it doesn't actually stop there. Now, there's so much more to learn. Don't stop studying. I can't stress this enough. No matter how much you think you know, there's always something you don't know, right? And in order to be a profitable trader on a consistent basis, you have to keep studying. Know how your pairs work, and that's where you can start digging a bit deeper. If you're studying one pair, then you know that one pair is going to move between 1 o'clock and 2 o'clock in the afternoon. At between 9 a.m. and 10 p.m. it's very slow. Towards the end of the week, there's not much movement, right? That's all to do with studying the charts, the time analysis. So we're going to speak for that briefly on the next slide. But I pretty much touched it already. Master one pair. Once you've mastered that one pair, you can actually trade profitably off that one pair. And many traders have actually done that, and they really do suggest that mastering one pair. Now, we have many traders in our live sessions, and they are 6-figure earners moving fastly towards 7 figures, and they're saying, listen, look, all I done for a good 3 to 4 months, I just won off this one pair. I know how it moves. I know when it's gonna move, when it's the best time to sell, when it's the best time to buy, when it's the best time to leave it alone. That's because they've mastered it, and that's all part of studying, right? When it comes to study, it's not always necessarily reading up different indicators or read up the technical analysis. It's all about the fundamental analysis. Now, we have one trader. He's a beast when it comes to fundamentals. Like, the fundamentals is another way for news, right? Every time he trades, he knows what's going to happen when, because he's actually listened to the news, and he said, this is why this happened. Well, this news impacted this, as in due to previous news, what X amount person said, or due to the demands of this company here, this is where price action is going to go. So from him looking at the news, and from knowing that one pair, he actually knows where things are going to go, pretty much just from the news, and obviously a bit the technical analysis as well. That's why it's very important. Now, this one here, placing the trade, like I said before, look at the news. I can't stress this. Look at the news. A good news resource for trading is Forex Factory or FX Book. Now, when it comes to the news, as a beginner trader or someone that's actually getting to trading for a while, it's always recommended that you don't trade red folders. Now, red folders is high impact news. What does that mean? That means the market can go up and down one way very quickly and swiftly. So when it comes to that, make sure you're looking at the news, because one day it can go up and the next minute it can go up and down in the same direction within a space of 10 minutes just because of the news. And I've actually seen it happen when I was actually trading one of the pairs, and it actually took me to go on a live trading session with this platform here. Is the only reason why I actually pretty much made my money back, or I was just in a bit of loss by that 10p, just because I was actually trading through the news. And I knew that myself. I knew it was a red folder, but I was like, okay, let me trust these traders' analysis and go through it. But I was like, hold on, I went against my own analysis and my own trading platform and my own plan to say, don't trade red folders. And that's what I did. But luckily, we got through it. The market was on our side that day, and we actually got through it. But yeah, for me, future reference, don't trade for the news. Don't trade red folders. Even if it means you have to leave that pair for that day, or even leave that pair that you're only trading for the day, my suggestion would be to leave it, because you can actually blow your account or actually go further down. Now, that's when we start talking about, having an ego and getting your emotions involved. Now, because you could be highly expecting, oh my goodness, yes, high news now, this can go up by like 50, 60, 70 pips, meaning that if you have like a £1 lot size or a 10 lot size, we're talking hundreds of pounds, or pounds even in general, that got up 70 pounds in the space of like 5 minutes. At the same time, you can lose 60, 70, 80, 90 pounds in the same space of 5 minutes. When it comes to the Forex market, especially, that high impact news can really mess you up, and I've experienced it, and it's not a good feeling. But that's what comes with emotions involved, because I should have taken that away. But I'm in the process. Trading is a process. We have to get used to that process. That's why I can't stress enough the news and a trading plan. Marking up charts. Now, when it comes to marking up charts, there are two things, and there are people say different things, but they mean the same thing. A top-down analysis or a multiple time frame analysis, they mean exactly the same thing. Depending what type of trader you are, whether you're a swing trader, a day trader, or a scalper, every person marks up the charts. Now, for me, what they're teaching in our educational platform, most of our traders, they are intraday traders, which means they're pretty much day traders, and they pretty much hold trades for 2 to 3 hours, right? So what they do is they go on the higher time frame, or the higher time frame they use is pretty much a daily one. Now, from that daily time frame they're using, they can find the support and resistance, the lowest low for that day that's respected support and resistance, and the highest high that has respected support and resistance. That basically means you have the lowest of that day and the highest of that day, and where price action is moving up and down. That's all support resistance for now, right? And then you go to start with smaller time frame, which would be 4 hours. Do the same support and resistance, mark it up. Then go into the hour time frame, do the same thing again. And then once on the hour time frame now, that's when you're starting to kind of look at where market structure is and looking at things are, so on and so forth. Go to the smaller ones and the smaller ones, so you can have a real understanding between the hour and the 30 minutes where price action is, before you start thinking about where to place trades. And this comes down to identifying market structure. Once you've done your top-down analysis, or your TDA, that's when you can start looking at market structure. Market structure, to put shortly, is when the market is going up, known as the bullish market, or when the market is going down, whether it's bearish or whether it's consolidating, moving side to side. That's what market structure is. But we can only see that from actually marking up how market moves between different supports and resistance. And with that, identify market structures as well. That's where we can start using different indicators if you choose to use them. Now, the indicators that I found very useful is pretty much the 50 EMA, which is the 50 moving averages from that point to the point before, whether it's a daily, hour, so on and so forth. It brings it all together online, and it shows you the averages of price action. More 9 times out of 10, when market structure is above the MMA, that means the market's moving in a very bullish market. When anything below the 50 EMA, it's in a bearish market. So that's a great indicator as well. And also as well, when we identify that, we also have other tools that we're going to go to find our entry point, our exit points, which is known as confluence. And confluence is just a fancy word for confirmation of what entry and exit points are. So there are many ways we can identify that. And they always say look for 3 points, and that's the support and resistance. That's 1 point. Another point could be the indicator 50 EMA. Another point could be a trend line. So basically, a trend line is like one line identifying which way the market is going. Another one could be price channels. So price channels is pretty much support and resistance and going in one direction. So it's like moving side to side in an upward trend or a downward trend. That's price action. Or it could be a 20 pips and dips indicator that could actually show you the direction of where the market's going. There's just no top 5 on my head that obviously that can decide where entry point is, because where the entry point is or where it may change or where it's continuing due to price action, with those 3 confirmations, that's when you can actually start finding an entry point. And also because you've done your markup analysis on the TDA, you can then actually see an exit point where you want to exit and where you want your trade to stop. Now, when it comes to placing a trade, there's the you have to stop loss and you have to take profit. I would highly recommend using a stop loss and also using a take profit, because a take profit means how much money you're happy to make. You don't want to be too greedy, like I said, but then again, it depends what type of trader you are. If you're like a swing trader, you might want to go for the highest one or a very, very high one. So you might have a slightly longer trade before you actually take profits if it makes there, and a slightly bigger stop loss, which way the price action goes. But nevertheless, once you've got those confirmations, that's where you can start finding your entry points and your exit points for your trade. And that's it. Short and sweet. I wish you every success. Applied knowledge can set you free. Now, like I said before, I can't stress enough when it comes to the trading game, which I've been in for a short while, but I understand that, without proper guidance, for me, without attending live sessions, going to the back office, using the resources that we have, it's going to be very challenging to be a profitable trader. And like I said, with education and the right people around you, your network, you're going to achieve what you want to achieve much more quickly. I know many people are trading independently, which they have done before. I know when they've come to this program here, they're actually much more profitable just because there's small things that are missing, and that small things that are missing is actually giving them an income jump in what they need to achieve. So I can't stress enough, please make sure you are studying in the back office, you're using your other resources. The Candlestick Bible is a great book. It's in this group here. If you don't have it, let me know, I can save the link. Or if you want like the hardback, feel free to purchase it on Amazon or eBay, wherever you get your books. But yeah, I'm a firm believer, an applied knowledge is the key to success, happiness and wealth. I live by that, so on and so forth. Because at the end of the day, you can have the knowledge, but if you're not using it and you're not applying it, what good is it, right? So you have to make sure we are using it. And if you don't understand something, please reach out to someone who may have an understanding, or go to somewhere that where you can find the answer. But we have a wealth of knowledge within our trade community, and if you can't find the answer there, someone will have the answer. But don't be afraid to reach out and ask questions, because that's one of the best ways of learning, is by asking questions. If you don't ask, you don't get, right? And the person that asks the most questions is the person that wins, because they're gaining more knowledge. Always question. Without questions, we can't solve problems. And how do we solve problems? From solutions, by asking questions. But yeah, I don't want to go on too much. If you have any questions, please feel free to leave them in the comments on the Facebook Live. If you're on live now or on the Zoom, feel free to type a message there. But with that being said, have a great day wherever you are around the world. I look forward to hearing from you. Feel free to connect with me in the group, on Zoom, wherever you may see this video. Like I said, I wish you every success. Let's get it, let's eat. This is a $6.8 trillion industry. There's enough for everybody. Take care, everybody. Have a great day on purpose. Take care.